Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
Good morning.
We've got a fresh batch of financial news to dig into today. We're pulling from, the usual places, Bloomberg, CNBC, MarketWatch, and Yahoo Finance, too.
Right. Lots to cover.
And our goal, like always, is just to cut through some of the noise, figure out what these stories are really telling us about the markets and, what it might mean for you.
Absolutely.
Yeah.
It's definitely a complex picture out there right now. You got different signals coming from different sectors, different parts of the world.
Yeah.
We're seeing some potential bargains maybe in some spots, while other areas are dealing with, geopolitical stuff and changing economic forecasts. Our job is to try and piece it all together.
Okay, let's dive right in then. There's a really interesting piece from Bloomberg. The headline is, "A Trade Made for Buffett. Energy Stocks Price Below Book Value." It's saying that a pretty big chunk, like around a third of U.S. mid and small cap oil and gas companies are trading below their book value right now.
Yeah.
Companies like Murphy Oil Corp., Crescent Energy Inc., Noble Corp. I mean, when you hear that, it almost sounds too good to be true, right? Finding dollars for 80 cents?
Well, that's the classic value investing idea, isn't it? Buying something for less than it's supposedly worth.
Exactly.
And the article really frames it like that, an opportunity to buy assets for less than their theoretical liquidation value. That kind of deep discount naturally gets value investors interested.
And Bloomberg actually quotes Cole Smead. He's the CEO of Smead Capital Management. He's not just watching, he's actively buying these. Calls them cigar butts, which is a funny image.
Yeah, the old Graham analogy. Still got a few puffs left.
Right. He thinks they're way undervalued and should at least get back to book value. So what's going on here? Why are these energy stocks so beaten down?
Well, the Bloomberg article points to a few things coming together. First, the energy sector itself. It was the second worst performer in the S&P 500 in the second quarter.
Ouch.
Yeah. That started with President Trump's tariff talk back in April, which got people worried about trade wars, economic slowdowns.
Okay.
Then you had OPEC increasing production, and that just pushed crude oil prices down quite a bit. West Texas Intermediate dropped to around $55 a barrel.
That's a big drop from where things were.
Yeah.
I remember the article mentioning a little recovery after the U.S.-China trade truce seemed to happen, but overall oil prices are still down, about 15% for the year?
Something like that, yeah.
Yeah.
So the market's clearly pretty pessimistic about energy's near-term future.
Seems that way.
That pessimism is baked into those stock prices. But it's interesting, the article does note that some of those stronger companies, the ones with good balance sheets like Cenovus Energy, they've been using this dip to buy back their own stock.
Right, which suggests the companies themselves think their shares are cheap. That's a good sign, usually.
It can be. But the Bloomberg piece also brings in a really important counterpoint. It's from Jeremy McCrea, an analyst over at BMO Capital Markets.
Okay, what's his take?
He basically says, look, book value alone might not be the best way to value energy companies.
Why is that?
Mostly because commodity prices are just so volatile. Oil and gas prices swing wildly. He thinks metrics like cash flow, EBITDA, that's earnings before interest, taxes, depreciation, and amortization, basically a proxy for operating cash flow.
Gotcha.
And maybe reserve values give you a better picture.
That makes sense. Book value is just a snapshot, right? It doesn't really capture future potential or the risk from those price swings.
Exactly. It's a critical point. But interestingly, McCrea also says that even using those metrics cash flow, EBITDA, the sector, still looks cheap to him.
Huh. So even by his preferred measures, it's undervalued.
Seems so. And he makes that classic point.
Yeah.
Often, the times when it feels most uncomfortable to invest in a sector like energy, those end up being the best times.
A buy when there's blood in the streets idea.
Sort of, yeah. So for you, the listener, this energy situation could be a value play. But you've got to look beyond just the book value. Really dig into the cash flow, the reserves, understand the cycle.
Okay, good takeaway. Let's shift gears now and look overseas. CNBC had a report, Asia-Pacific markets live, Japan GDP, Hong Kong GDP, kind of a roundup of the region.
Yes, and it was definitely a mixed picture across the board. Japan's latest GDP numbers came out, and they actually showed a contraction, down 0.2% quarter on quarter, which was a bit worse than expected.
Weaker than expected, but the markets didn't tank.
Interestingly, no. The Nikkei 225 index closed pretty flat, and the Topix actually edged up slightly.
Huh. And this is happening while Japan's in the middle of trade talks with the U.S., right?
Exactly. That's important context. The thinking, according to CNBC, is that this weaker GDP data might make the Bank of Japan a bit more hesitant about raising interest rates anytime soon.
Okay, keep policy loose.
Potentially. And it could also affect the yen. The article noted it was trading around 145.5 against the dollar. Maybe this weak data adds a little upward pressure on the dollar versus the yen.
All right. And what about the rest of Asia Pacific? Sounds like it wasn't all down.
No, definitely varied. Australia's S&P SX 200 was up. South Korea's main index, the Kospi, was also up, though their smaller Kosdaq index fell.
Okay.
But then you had India's Nifty 50 down, Hong Kong's Hang Seng was down, and mainland China's CSI 300 was also lower. So, yeah, real mix. Just shows how local factors and global trade stuff combine differently in each market.
Yeah, definitely not a monolith. What about this note in the CNBC piece about record foreign money flowing into Japanese stocks and bonds back in April? That seems odd given the weak GDP.
It does seem a bit counterintuitive, yeah.
Yeah.
But the article suggested it was partly investors looking for somewhere else to put their money after Trump's earlier trade actions made U.S. markets feel a bit uncertain. Japan looked like a relatively safer bet.
Ah, the safe haven flow. Interesting. It really shows how connected everything is. Money sloshing around based on policy moves elsewhere.
Absolutely. And speaking of outlooks, Goldman Sachs apparently lifted its view on Asian stocks. They're seeing better growth prospects and maybe a bit of a thaw in U.S.-China tensions helping things.
So some optimism there. But it wasn't all rosy in the company news, right?
No, definitely not. Alibaba's Hong Kong shares slipped because their profit missed expectations, even though revenue was up year over year.
Okay.
And Singapore Airlines, they reported record full-year profits, but their actual operating profit was down because of tougher competition. So, nuances even within the good news.
Right. Always got to look under the hood. Okay, let's bring it back home to the U.S. CNBC had a couple of their daily open headlines that caught my eye. U.S. stocks are buoyant for now, but lurking dangers could weigh them down, and U.S. stocks are rallying, but beware the after effects of a head rush.
Yeah, those titles capture the mood pretty well, I think. Cautious optimism? Maybe.
Sounds like it. They point to the S&P 500's four-day rally, pretty strong performance, general good feeling among investors. That brief cooling of trade tensions probably helped. The S&P gained something like 4.5% over those 4 days.
Yeah, a solid run. But then you get those warnings, the lurking dangers, the head rush. What are they pointing to specifically? What could derail this?
Well, the CNBC reports flag a few things. One, despite the trade talks, China is apparently still holding back on some rare earth mineral exports to the U.S. That's key for tech, defense.
Right, those strategic materials.
Two, there was President Trump reportedly telling Apple's Tim Cook not to build in India. Just highlights how complex these trade and investment talks can get.
Yeah, direct political influence.
And maybe the biggest one, Fed Chair Jerome Powell warning about potentially more frequent supply shocks hitting the economy.
Yeah, I saw that.
Which could mean more volatile inflation and maybe higher interest rates for longer.
Powell's warning there definitely adds a layer of caution. Those supply shocks could be anything from geopolitics, messing with oil, to, I don't know, pandemics disrupting supply chains. They can really ripple through the economy.
For sure. And CNBC contrasts the U.S. rally with Japan's economy shrinking, which we just talked about. Kind of a divergence.
Yes, it makes you wonder, right? Can the U.S. market keep charging ahead if the global picture has these underlying weaknesses?
Good question. And that mention of the Trump-Tim Cook conversation is pretty striking, too. Just shows how politics can directly intersect with corporate decisions.
No doubt.
Okay, let's stick with U.S.-China for a moment. Another CNBC piece. China calls U.S. trade talks good, as Trump hints at she-call. Sounds a bit more positive.
Yeah, on the surface, maybe. China apparently described those recent talks in Geneva as good. Their trade envoy, Li Changgang, sounded pretty positive.
Okay.
And that's led to some hope that maybe the friction is easing up. The U.S. holding off on new tariffs, for now, seems to have been received well in Beijing.
That's definitely good news for businesses caught in the middle. But the article also says, despite the good talks, there are still pot shots being exchanged. What are the sticking points?
Right. Even with the diplomacy, the U.S. is still voicing concerns about things like Huawei and their AI chips.
Mm-hmm.
And China's pushing back against what they call U.S. long-arm jurisdiction. And again, those export controls, especially on rare earths. So, yeah, the top-level talk might be better, but the core disagreements are still there.
Feels like a fragile truce, maybe? They're talking, but haven't solved the big issues.
That's a good way to put it. And the article had an interesting perspective from Dennis Wilder, suggesting China might be overplaying the rare earth card a bit that the U.S. could find other sources if needed.
Interesting strategic angle. So for you, the listener, the takeaway is, yeah, maybe some thawing in U.S.-China relations, but don't assume all the problems are gone. Yeah. Still lots of tension under the surface. All right, let's pivot to AI and tech. Lots happening there. We saw several CNBC articles, one about Chinese companies using AI ads, another on Musk's Grok chatbot controversy.
Right, the NVIDIA stake in CoreWeave.
And that US-UAE deal on AI chips. Quite a mix.
Yeah, let's start with the positive AI impact in China. The piece on Alibaba, Tencent, JD.com, suggests consumer spending is getting a boost partly because AI is making online ads much more effective.
How so?
Well, Alibaba saw strong sales growth on Taobao and Tmall. Tencent's marketing revenue was way up, driven by ads in short videos and WeChat, and they credited upgrades to their AI for that. They even mentioned AI ads getting close to a 3% click-through rate, much better than older formats.
Wow, 3% is pretty high for click-through. Shows AI is really working there for targeted advertising.
Seems like it.
Mm-hmm.
And JD.com also saw revenue rise, partly thanks to using large language models to make their ads convert better. AI is clearly becoming a huge driver for e-commerce and ads in China.
Definitely. Now, on the flip side, that story about Musk's XAI Grok chatbot and the white genocide posts, that sounds pretty bad. What happened?
Yeah, it's definitely concerning. According to XAI's statement reported by CNBC, someone made an unauthorized modification to Grok, causing it to generate these unsolicited and deeply problematic responses about white genocide in South Africa.
Yikes.
They were very clear it violated their core values and policies.
That's really disturbing. What's XAI doing about it?
They say they've investigated and are putting measures in place to improve transparency and reliability. They're planning to release the system prompts publicly on GitHub, which is interesting.
So more scrutiny.
Yeah, seems like it. And they're setting up a 247 human oversight team to catch things the automated systems might miss.
Good that they're taking steps, but man, it just highlights the huge challenge of keeping these powerful AI models unbiased and preventing harmful output. A real ethical minefield.
Absolutely. It's a critical issue as this tech advances so quickly.
Okay, switching to the financial side of AI, NVIDIA owning a big chunk of CoreWeave.
Yeah, CNBC reported NVIDIA held about $900 million worth of CoreWeave stock at the end of Q1. CoreWeave provides AI infrastructure, basically renting out NVIDIA's own GPUs for AI training.
And CoreWeave stock has done well since its IPO.
Extremely well, apparently, so NVIDIA's stake is likely worth a lot more now. CoreWeave itself reported, get this, 420% year-over-year revenue growth. Just shows the insane growth in AI infrastructure.
420%. Wow. NVIDIA's playing it smart, selling the shovels and investing in the gold miners, so to speak.
Pretty much. And then there's that US-UAE agreement on AI chips.
Right. What's the significance there?
It really signals the UAE's ambition to be a major global player in AI. The deal, announced by President Trump, is meant to ease some U.S. security rules that had limited exports of top-tier chips to the UAE.
So they can buy more advanced chips now, like NVIDIA's H100s.
Potentially, yes. There was talk of a very big contract. It would give their AI development a massive boost. It also suggests maybe a slight shift in U.S. export policy and just highlights the growing global race for AI dominance.
And then maybe more international collaboration.
Interesting. Okay, let's pull back to the broader economy and the Fed. We've got Yahoo Finance and Bloomberg reporting on comments from Fed officials.
Yeah, first up, Fed Chair Powell. Yahoo Finance covered his warning that the U.S. might be heading into a time with more frequent and persistent supply shocks.
Supply shocks, meaning disruptions.
Yeah, things that disrupt supply chains, commodity markets. Could be geopolitics, extreme weather, you name it. He thinks these might happen more often now.
Yeah, it leads to
more volatile inflation, which makes the Fed's job harder. Powell stressed the need for really clear communication from the Fed in that kind of environment.
Sounds like he's bracing for a bumpier ride, economically speaking.
That seems to be the message. More uncertainty, potentially. Okay, but then we have Atlanta Fed President Raphael Bostic, reported by Bloomberg. His view sounds a bit different.
A bit, yeah. Bostic said he expects the economy to slow down, but he doesn't see a recession coming. And he's still only expecting one rate cut, sometime in 2025.
Only one cut next year. Interesting. Did the trade news affect his view?
He mentioned the U.S.-China de-escalation had slightly changed his outlook, yes. But he also echoed Powell's concern that tariffs could push inflation up, which might limit how much the Fed can actually cut rates.
So even within the Fed, you've got different takes. Powell focusing on supply shocks and inflation volatility, Bostic seeing a slowdown but no recession, cautious on cuts.
Exactly. It just underlines the uncertainty right now about where the economy's headed. No clear consensus, even among the policymakers.
Right. Okay, let's talk market momentum. MarketWatch had an opinion piece. The stock market's momentum swings both ways. Don't get hit. And another article, why Friday's options expiration could send this historic stock market rally skidding to a halt. Sounds like warnings of a pullback.
That's definitely the theme. The opinion piece notes some bullish signs, like momentum indicators, the de Graaf breadth thrust, the VIX falling fast, things that often point to more gains. But the author argues the market might have run up too fast, too quickly. It might be overbought and due for a pause or correction. They also note that while the big indices look great, the rally hasn't been super broad. A lot of it driven by just a few mega-cap tech stocks, the so-called Magnificent Seven.
Ah, the narrow leadership concern.
Exactly. And then the other MarketWatch article gets really specific about this Friday's options expiration. How could that cause a stall?
Yeah, explain that. How does options expiration affect the market?
Okay, so the article points out there's a lot of bullish call options expiring. Dealers who sold those calls likely bought the underlying stock to hedge their risk.
Right, delta hedging.
Exactly. That buying pressure from the dealers has helped push the market up recently. But as those options get close to expiring, especially if they're not going to finish in the money, the dealers don't need that hedge anymore.
So they sell the stock they bought.
Potentially, yes. They unwind those hedges. That can create selling pressure, what the article calls bearish hedging flows, and basically take away a source of buying, maybe even stall the rally. The total value of options expiring Friday is apparently huge.
Okay, so it's a technical factor, the mechanics of the options market. That could cause some short-term turbulence.
That's the idea. Danny Kirsch at Piper Sandler was quoted expecting more volatility next week once all that hedging activity settles down. It's just a reminder that these market mechanics can really influence things in the short term.
Good reminder, especially after a big run-up. Okay, let's quickly hit a few other headlines before we wrap. Bloomberg reporting gold advances as economic data supports Fed rate cut bets.
Yeah, pretty standard relationship there. Weaker data increases odds of Fed cuts, makes non-yielding gold look a bit better, though the article did say gold's still below its recent highs.
Why is that?
Well, the easing trade tensions probably reduced some of the safe haven demand for gold. But it's still getting support from ETF buying, central bank purchases, and strong demand out of China this year.
Got it. And MarketWatch. Warren Buffett's Berkshire Hathaway dumps Citigroup stake, trims Bank of America, Capital One. Big moves in bank stocks for Buffett.
Yeah, significant reduction in big banks in Q1. Sold all of Citi, trimmed BofA, and Capital One. But they boosted their stake in Constellation Brands, the drinks company. Apple holding was unchanged.
Interesting shift. People always watch Berkshire's moves closely.
They do, though. Remember, this is backward-looking data from Q1. CNBC's Big Stock Stories also touched on this, recapping the S&P rally, mentioning key index levels. They also flagged more 13F filing details. David Tepper cutting back on Chinese tech, buying more Uber and Apple, confirmed the Buffett moves.
Yeah.
And noted Michael Burry of Big Short fame has a short position on NVIDIA now.
Burry shorting NVIDIA. That's a bold call against a market darling.
It certainly is. Contrarian for sure.
Okay, finally, Treasury yields in oil. CNBC said Treasury yields were lower as investors weed the economy.
Right. Softer data, trade progress may be influencing yields, though Powell's warning about higher long-term rates is still out there.
And Bloomberg on oil. Oil falls after spiking on Iran-U.S. nuclear deal uncertainty. A bit of a whipsaw there.
Yeah, quick jump on uncertainty about U.S.-Iran talks. Then it fell back. If a deal happens, more Iranian oil could hit the market. Plus, the International Energy Agency is forecasting a potential supply glut anyways. That's weighing on prices.
Okay, so lots of moving parts across all these markets. Stocks, bonds, commodities, currencies, all reacting to trade, economic data, geopolitics.
It really highlights how interconnected everything is. You need that broad view to understand what's driving the markets.
Well, this has been quite the tour through the headlines. Energy value plays, mixed signals from Asia, a buoyant but maybe fragile U.S. market, U.S.-China complexities, AI breakthroughs and controversies, Fed uncertainty, market mechanics. Lot to unpack.
Definitely a market with both opportunities and risks right now. Requires careful thinking.
So thinking about all these mixed signals, the potential value in energy, the trade uncertainties, the AI boom, the chance of a market pullback, What's one perspective or maybe an area of research that really stands out to you that feels most critical for people to dig into further right now?
That's a good question. For me, I think it's the continued acceleration of AI and how it's rippling through everything, not just tech stocks, but advertising, like we discussed, supply chains, productivity, maybe even geopolitics with deals like the US-UAE one.
Mm-hmm.
Understanding the second and third order effects of AI's advancement feels really crucial right now. It seems to be touching almost every other theme we talked about.
That's a great point. AI isn't just a sector story anymore. It's becoming embedded across the economy. Definitely something to keep a close eye on. Well, that wraps up our deep dive for this week.
Yeah, good discussion. Lots to think about over the weekend.
We'll see you all Monday morning with new headlines from major financial magazines.